we don't listen to pitches. And that's why we work by referrals only. And the referrals we're getting fill our capacity. And sure, if Michael and I thought that we had a crystal ball and we could recognize who is going to succeed in the future when we listen to a pitch for them, then we would really worry about this.
So it allows us to check some of those biases that we may have internally and simply reward based on where is the next incremental risk-adjusted return on the dollar going to make the most for our investors.
Hey guys, welcome to VNTR Podcast, and today we have Michael and Kamal, co-founder of Loyal VC. Hey guys, welcome. And as usual, let's start with a quick introduction. Michael, please start with a quick intro, then Kamal, and we will.
Great. Thanks so much, Yuri, for having us. I've enjoyed our interactions over the years and the help we've gotten from Venture. So congrats on the progress, and happy to contribute here as for those who are interested. I'm Michael Kosic, lifelong entrepreneur, industrial engineer by first degree, INSEAD MBA by second. Amongst other things, took a sensor technology company through concept patenting, licensing, profitability. Kamal and I worked together in a variety of different capacities over the years, including at a startup, on the alumni executive for INSEAD, and at the Founders Institute. And about 8-9 years ago, we were talking about early stage investing, thought we could do things a little bit differently, a little bit better, launched Loyal. So we're going to talk about some of that today. And I think, Kamal, this is actually the first podcast we've been on together, isn't it? Interestingly enough. Anyways, over to you. Make your intro.
It's good to connect you together.
Yeah, it's good.
Thank you.
Yeah. Nice to see you, Kamal.
There we are. We travel a lot. Michael's just back from Singapore, and I haven't seen him for a few weeks. So I spent the first decade of my career with a good career that my father would approve of, with an engineer, MBA, Bain & Company, and then I became an entrepreneur. After that decade, so been an entrepreneur, angel investor for a couple of decades, and then I launched Loyal with Michael, because it's really funny when you get entrepreneurs together, they sit around and they complain about venture capitalists if they're sort of around drinks together. So we decided to try to build a fund which sucked a little bit less and would be harder to complain about.
Yeah, that's cool. Can you talk about this part? Like, how did you guys trigger launching Loyal? Right? Like, what sucked? What sucked in VC?
Yeah, the origin story. So it's interesting. As I mentioned, we had known each other for many years, but about 9 years ago, we were talking about some of these problems and opportunities, and there was a 90% overlap, I would say, in the problems we had identified. But what was really amazing, there was an 80% overlap in our kind of independent thoughts about how we would do things differently. So this was the lightning strikes moment that some founders have. Oh my God, I found somebody here that's crazy in the same way that I'm crazy. So at least that was my my perception, and that I had known Kamal for all of these years, that I trusted him and thought so much of him. It was a wonderful kind of a place to start. Kamal, you want to talk about some of those problems that we identified?
It's worth mentioning, I mean, both of us had been independently working on this. I'd spent about 1.5 years flying around the world looking for the right partner to launch with this, like interviewing sort of senior people in Singapore, leaving other venture funds, and talking about how this different way of doing venture. And they were like, I know how to do venture the old way. I don't want to do it differently. And then it was just this accident. Someone you actually know and hadn't been in touch with for a while was doing the same thing. Sure, some of the problems. Look, entrepreneurs always complain that VCs make dumb decisions. And it's like, whether or not you invest in me, great, but I'm part of a community of entrepreneurs, and I know all the other entrepreneurs are out there. Why are you investing in one of the not so good ones when the good ones are the ones you're passing on? So there was a real question around how VCs made decisions, and wanted to think that one through. There was Michael and I both made money as angel investors. And there was the question of, did a fund exist that was better than making money ourselves as angels. And the big thing we saw is my top angel deal, I got over 30 times my money back. It took me 14 years from the day I invested till the day I cashed out. And when I was in my 30s, I didn't mind waiting 14 years. I'm in my 50s now. I don't want to wait 14 years to see my money. So that's one of the things we did is we said we really need to have liquidity in the fund, because if you can have a fund which has some sort of liquidity to it, then all of a sudden that's way better than writing a bunch of checks and waiting to see what comes back in 10 or 15 years into my pocket. So that was one of the other big things we looked at was, make smarter decisions. Yeah.
Yeah, on that angel side as well, I didn't have the personal capital to double down mathematically on a lot of the great deals I was already in. So that's one of the things almost in any path I think you walk in life. You get to a point, if you're doing it right, that you realize that you can do even better and have even more of an impact if you get others involved. So there's only so far you can go alone, and I think that it's part of the at least my motivation to move away out of being this individual angel to doing this with and for a community of people that I respect.
That's actually maybe a good transition, because there's a third audience. Everyone thinks of the entrepreneurs and everyone thinks of the LPs, the investors in the funds. There's actually a third audience for us, which is really important, which is the advisors. And both Michael and I have advised tens, if not hundreds, of startups. And there are some people who do the advising setup really well and some people who do it really badly. So we actually spend a lot of time thinking about setting up a fund we'd want to advise for as well. And we have over 1,000 advisors now around the world. And that's an important part of, as Michael said, you want to bring this community of people together. And bringing the people who are those experts who want to support startups is actually a really important part of that, especially because there's lots of ways to compensate, to help startups for free, but relatively few that give you a chance to actually make money if your advice causes the startup to make money as well.
No, that's true. We'd been, both of us individually and even together at a startup, part of several accelerators and incubators where these accelerators and incubators essentially take advantage of many advisors who are out there in that pay it forward part of their lives or careers. These advisors create a lot of value, but they capture very little it for themselves. It's typically captured by the accelerator or incubator. And we as entrepreneurs, when we were identifying these problems and putting together our solutions for them, we, begged, borrowed, and stole from, we stood on the shoulders of others. It's very common. One of the things I liked, so Kamal started the Founder Institute chapter in Toronto. And one of the things I liked about that program is the mentors are rated, and you get a small, tiny slice of a carry pool, but it's incremental and it's based on your performance. So, I did the math because I always do the math. And it's, you're not talking about a lot of dollars, but just the fact that I was measured, and just the fact that I was compensated in a relative manner was an interesting little intellectual nudge. So I think that's a common thread through what we run. We try to treat everybody fairly, and you get the right incentives and good people together, and magic happens.
Let's step back into how did you get started, right? So let's say you found each other and you guys decide, okay, let's start a new VC that doesn't suck, or that has a different model. What are the steps, right? Like how much time did it take you to come up with the model? How much time did it take you to raise the first money, right? It's kind of, what was the journey like as an entrepreneur that building a new co?
Well, so I would say I think, at least from my memory, maybe we spent more, maybe we spent less, but we spent about a year in kind of formation. I would say, and a lot of that.
We each independently spent time before that getting the ideas straight. But from the moment we sat down to have lunch, to the fund actually raising money, you're right. I think it was about a year.
So one of the things that is one of the biggest innovations, I said that we not pioneered, but close to it, I would say, is this open-ended fund structure. So we spent some time going around and asking people about this, and talking to our peers about and those seniors, folks who had invested in funds before. The interesting, so we talked to a few. I think there's been 200, at the time there was about 200 open-ended funds since the dawn of venture capital, and even most of those were leaning towards unique kind of infrastructure types of plays, or longer-term kind of plays. But we did talk to a few folks that had run some of these funds, and there were two kind of messages that came back that stuck with me. One of them was, don't worry so much about redemptions. When you start making money with and for people, the tendency is to put in more money, not to take it out. That was an interesting kind of thing to comment on. The second was,
which has been true, by the way,
which has been true for us for sure, and we can talk about that in more detail in a bit. But the second one was that one of them said, if we had held on to our companies after they went public, we would have made twice as much in the appreciation in the public markets as we did inside of the fund. So VC is legalized insider trading. Right, you have information asymmetries. You know ahead of many other people, because you have a great relationship with the entrepreneur, that they just landed a great deal with a great partner, and you say, okay, this is pre-inflection point. Every investor wants to get in pre-inflection point, and it's a series of inflection points, as that's the funding stage journey. So it is that kind of legalized insider trading. But we thought, the reason and the value we bring is is partly in that information asymmetry. And once a company is public, we might have a good relationship with the CEO, but we have no longer access to that asymmetrical information. So our bias and we're currently set up as a structure to, when any of our companies go public, to sell those shares and distribute back to our investors. So those were the two of the learnings, or kind of things that we heard about from people that have already been doing it. I can talk about some of the other learnings. Kamal, do you want to jump in with anything before I do?
Well, I was going to say, just to round out the origin story a little bit, the practical side you asked about, Yuri. So about a year there, we actually had a third partner who we were brought in to work with together on this, who was from the venture capital industry, who worked with one of the big groups locally. And he was all excited about the plan, et cetera. And we developed all the materials, everything going out to launch the fund. And we realized that there was enough innovation to this that we wouldn't be able to pull together easily sort of $50 million, which is really the minimum for a good fund. And Michael and I said, that's fine. We'll just, we have a funding process which starts with small amounts, and then sort of try before you buy, test out the companies, get to know them, be in the right position to then put in more money at the later point in time. And so we said, let's launch. And we launched with $600,000. That was our first close. And this guy looked at us back and forth. And a couple of months before we were going to do this, he just looked and said, you guys are crazy. Why would you launch a fund that can't afford to pay your salaries? I mean, I'm from this industry. I'm not going to join a fund that doesn't have $50 million. A great guy, really knowledgeable, everything else. But Michael and I were just like, look, we're entrepreneurs, and we're used to, you launch a business, you don't have a salary. We've got very understanding wives, and we certainly do our best to look after them so that they can continue to be understanding. But it was just like, no, of course you launch a fund without paying yourself a salary. That's not a big deal. But it was a big contrast between people from the industry and entrepreneurs who were just like, let's just go do this.
Yeah. Actually, they look after us, Lynn. Let's be honest here, Kamal.
True.
So that's, we're definitely built like entrepreneurs, as Kamal said. So
who were these first 600 people that believed in you?
Oh, it's very similar to the startups that raise. Your typical first money comes from people that know you, and the people that know you, it's generally divided into two camps. And one camp is oh, I know you guys, you've thought this through. I understand the intellectual position you're taking. I approve of it, guys. I really like this strategy. Here's some money. And you get the other half that say, I have no frickin' clue what you're talking about, but I really trust you with my money. So here's a check. That's the typical makeup of the two pools of that initial friends and family money, if you will. And I don't think we were any different in those first checks.
A lot of people say friends and family, and they exclude the Well, so the thing is, one of our fools, for instance, is the COO of $100 billion fund management business, who knew me and had invested in some of my past companies as past startup companies. And I think the two businesses he'd done before this with me, I lost money for him both times. But he still liked the way, the openness, the transparency, and he understood this. And he was like, sure, Kamal, I know you, I trust you. I'm going to put money into this one and make money for me this time. And so far, I think he's pretty happy with what we've done. But that's one example. So when you talk about friends, it's somebody who you built a business relationship with, who's had a chance to test you out, get to know you, and who really does trust you. And another one of the early investors is actually, and I think she's been public about this, so I think I can say it, has been a professor of venture capital at INSEAD, who was one of our first couple of investors. She was really excited with what we were doing, knows a lot of venture capital models, and was just really wanted to be a part. I mean, she knows venture capital well. She knows the different models out there, and she really saw some interest. Was really excited to be part of something new like this.
Yeah, it's interesting. One of the things that we did as entrepreneurs, as entrepreneurs, you always have at least 5 ideas about what you can launch next or things you could do. When we were, in formation, we were like, we're going to have an amazing data set here. We're going to have amazing data, not just on the companies that are succeeding and getting our follow-on money, because as we said, we have these very competitive stage process, very data-driven, but we'll also have a lot of data on failures. So we turned to each other and we said, you know what? We could simultaneously launch DataCo as a venture that would provide analysis algorithms and eventually AI to other funds, building in this space. But we had the maybe the wisdom and experience to say, let's stay focused. Let's not go out there and be the, hey, you want to buy this? No, you want to buy this? No. So very much we're playing the long game here with Loyal. So everything is very considered, structured, and some of it is necessarily, and this is a very important word, necessarily more complex. And that requires extra work. So to be an open-ended fund, you have to value every one of your portfolio companies in a fair manner every 90 days. If you are too conservative in your investments, and then you're undervaluing them, investors will take advantage of old ones. If you're too aggressive, the reverse is true, and you take that to an extreme, and you're running a Ponzi scheme. So you've got to be very careful, fair, and play the long game, and that's one of the things that we did.
So you also have a quite unique way of investing in companies, right? So how did you come up with this model of investing across four different trenches? Maybe you can elaborate.
Kamal opened up earlier on saying how entrepreneurs say to each other, why did they invest in that company? They should have invested in us, right? Look, and some of that falls on the entrepreneur. Which is, look, you have to learn whether you're an entrepreneur or a fund manager to properly communicate what your product strengths are. You can complain as much that the investors aren't smart or make snap decisions with not enough information, but ultimately that's the people and that's the world that you're dealing with, right? So the idea here of look, give me a chance over time was the real. I think we wrote a paper with Claudia about investing like why VCs should invest like poker players. So in the game of poker, nobody makes money off of the ante. The ante, that's table stakes. Actually, that's where the kind of word comes from, table stakes, right? It's that minimum amount. So our first check, always, with no exceptions, regardless of how much we love the company or the person that brought us the company, it's always 10K. Followed by 200K, then 1 million, then 3 million, then 8 million. And some of the problems that we had identified were a lot of VCs are subject to human biases and ego, human biases and decision making. So the idea here that you can write a small check and the next check you write has to be significantly larger stops you from throwing good money after bad. So it's not about, I was right 6 months ago when I cut this last check, and the entrepreneur, really nice person, just wants a little bit more money to go a little bit further. No, in this case, it's the 20 times if it's the first round, 5 times if it's the second round, what you previously invested. So it's a sizable kind of commitment. So that reduces that kind of human bias. So yes, that small ante.
Over the past 8 years, there was some inflation, right? So the 10K 8 years ago, it's 20K.
That's you know what? That's the first time we've ever been asked that question. There's no cost of living adjustment for entrepreneurs, right?
Very good entrepreneur. More entrepreneurs should be telling us this.
Absolutely. Look, again, we know for 85% of our portfolio companies that 10K doesn't move the needle. We operate in over 70 countries. There are countries where 10K can actually pay for a few developers to get you, far enough along to get to an MVP. To others, it's an expensive lunch in Zurich or San Francisco. It doesn't move the dial. So it's interesting. So we ask the other 85% of companies in our portfolio, why did you take our money? And it's roughly divided into 2 camps. The first camp is folks who say, look, I like the fact that Loyal has deep pockets. I like the fact that it is a competitive process. I like the fact, since 40% move to stage, that all I have to do is beat 2 other entrepreneurs in your portfolio, and I'm going to get the next check. Most entrepreneurs I know think they can beat at least 2 other people in the room. So if the 3 of us were entrepreneurs and we're out having lunch and I'm like, Kamal, I love what you do. Yuri, I love what you do, but mine is better. And if I didn't think that, I would be working with you, right? So that's the drive for a lot of those people, is that merit-based system, competitive nature. I'm going to get the next check, and if you add up all of our checks, it's actually 12.1 million. So significantly deeper pockets than your typical angel that they may have already exposed in their portfolio. Plus all of the other benefits of institutional capital from that perspective. The other half, I would say, again, of the 85% that the 10K wasn't meaningful to, they said, look, I can get money anywhere. I'm not worried about money. What I really want access to is your network. I want access to that support. We now have over 1,300 advisors. We pay them 20% of the fund's carry. Again, the fund would not scale without these advisors. And we knew from our own experiences that we had to make it, relevant for these advisors. So that's what they want. They want access to that network. They want access to the support, and we've built, I believe, a pretty good reputation of supporting, entrepreneurs. So,
what does it take to get the first 10K? Right, sounds like a easy one.
Great question. Well, it depends on the network you're coming from. So we source from 3 networks. The first and largest source is alumni of the INSEAD Business School. That's alumni of full-time programs. So the Gemba, the Temba, the MBA. And they're typically, we're not talking about students here. We're typically talking about 5 to 10 years out of INSEAD. And they're 55%, then about 43% Founders Institute. And then our own LPs. So with INSEAD has centralized quality control in the sense that folks apply to that school and then they graduate centrally. Founders Institute has, I would say, a distributed model. So they have 180 different cities around the world. They graduate 1,000 companies a year, and the city ecosystem ecosystems have varying degrees of quality. Some have a track record of putting out significant companies. We lean into those a little bit more. We've got good relationships with HQ. So we blend that local and centralized knowledge for Founders Institute and only allow a company into our portfolio after the director has recommended it and after we have asked and pulled from that director.
From any chapter around the world, right?
Correct. But again, we pull. While if you're an INSEAD grad, you're allowed to come and knock on our door. Now, one of the things that the Founders Institute has done well for applicants to its program is it uses the entrepreneurship DNA test to gather some additional insights for the applicants into the program, insights on themselves that they can reflect on and use. We use this as a form of filtering. This is not a you score high, you get in. It's a you score lower, you score with enough warnings. We don't believe you can predict entrepreneurial success, but there are attributes that are highly covariant with entrepreneurial failure. So it's a screen.
In a sociopath, for instance.
Yeah, exactly. Now, you might be able to pitch and get a good check, first check as a sociopath, but you're not going to be able to coalesce a team around you long term and kind of create value. So,
don't you feel like you're missing out on opportunities by focusing on these three pools?
Yes, there are some notable sociopaths that have created a lot of value in history, but those are.
I'm talking about in general the networks that you're focusing on. Not
So.
Yeah, we should jump back to that actually, because Loyal doesn't listen to pitches. And I know that's our industry's perception, is that you can listen to pitches and the best pitch is the company that's going to succeed. We don't listen to pitches, and that's why we work by referrals only. And the referrals we're getting fill our capacity. And sure, if Michael and I thought that we had a crystal ball and we could recognize who is going to succeed in the future when we listen to a pitch for them, then we would really worry about this. But we've accepted the fact that we don't know the future. We don't know for sure when we hear a pitch if that company will succeed or fail. So therefore, we just won't do the pitches. We'll just do referrals. And we've got great networks which fill our funded capacity. So too bad we don't need any other referral networks. And I'd rather do a referred founder any day, a referred vetted founder any day over someone in off the street.
And I, as we all do, have my biases. There are things that I think I'm more competent in assessing, but for many things, I realize that I'm a sample of one. So the beautiful thing about the Loyal process is there's obviously, these high quality and barriers from these networks to get in, but after that, it's merit based. So if a customer is buying the product, it doesn't matter that the product is not for me. That traction is coming through in the numbers, and that's part of our process, is to recognize and reward that excellence as evidenced by real results and traction, and those results, in this, it can be a little bit controversial to say, but they have no gender, they have no sexual orientation, they have no skin color, and quite often they have no geography. So it allows us to check some of those biases that we may have internally, and simply reward based on where is the next incremental risk-adjusted return on the dollar going to make the most for our investors. Yeah.
So how does do you have investment committee? Do you have do you meet with the founders?
So we have two investment committees. It's worth saying there's the how do you get into the fund? And how you get into the fund, there's really two types of investment committee. There's the, hey, I came through INSEAD, so I've got everything behind me from INSEAD. Let's face it, I'm probably a member of the global elite at this point in time, and we're doing reference checks on them as well from within the community. Then there's the Founder Institute. And look, anyone who wants to can go in the door at the Founder Institute. And there, our investment committee is the 50 or so mentors at that local chapter, plus the 1 to 3 local leaders who are checking out this company every week through a really competitive 14-week process. And they're helping us select the best one. Now, look, If I've got 40 people have screened that company and that director has been following their work every week for 14 weeks, watching them build their business, that is far better than any other work we could do. And oh, by the way, we're only relying on them to make a $10,000 check. Now, the real investment committee, as far as Loyal is concerned, is the fact that we have monthly calls with the entrepreneurs, take monthly data from them. By the way, we pay them $1,000 a month to send us data. If they don't have a call or they don't send us data, that's fine. They just don't get paid that month. And all of a sudden, those entrepreneurs who never want to do a report for their investors suddenly wake up and do a report for their investors because they want to get paid. And then we take that data. Typically, they'll have monthly calls over time with initially with Michael and myself, and then ultimately with 3, 4, 5 members of our team. And an investment committee is sitting down every month to rank all of our companies and to pick the best companies, the top companies from within that we then talk with an investment committee of senior people who already know the companies from talking to them to make the decision where to allocate the follow-on money, because 95% of our money is a follow-on money. The 10,000, and Michael said, it's just the ante to get into the game. The 95% is the money where you're actually making informed bets based on really understanding a company. And that's where we think we have an edge to make money.
So yeah, monthly calls with the CEOs is critical. It's critical for building the relationship. It's critical from getting them resources to help on the key problems that they're working on. And every third month, so diversity of opinion is very important. And at Loyal, every third month is what we call a swap month. That CEO is going to meet with somebody else from the investment committee. They're all senior folks, a third of them from venture, a third of them entrepreneurs, a third of them kind of corporate backgrounds. At Loyal, we're very data driven. We're very disciplined. The AI ingests all the data, helps share that. We all see the same data, but when we're an investment committee, if you've had a human interaction with the CEO, your vote counts for twice as much. So again, we believe in humans making decisions with and supported by machines. You're going to see, and you're seeing more and more the rise of purely quantitative investing in the venture space. Again, humans making decisions supported by expert systems. I'm an industrial engineer. You can argue that AI was actually born out of our discipline. It's there to support humans, not the other way around.
By the way, Michael mentioned DataCo that we were thinking of launching at the beginning. Even though we didn't officially launch DataCo, what we did, and we've done since day one, is we have a data agreement with every company, which gives us permission to use that data to develop these AI investing models. And we have massive amounts of data. As Michael mentioned, we value the company every quarter. Well, the biggest challenge if you're building an AI model is you're trying to correlate factors with success. Well, and with success and failure. So it's really tough when you're saying, okay, how do I know if a company's a success until I've exited from it 14 years later? Where do you get the data to build your model from? And oh, by the way, everyone's looking to try to find successes. We actually think, you can find lots of Harvard dropouts who never founded Facebook. They all failed. We only know about the one who did it. So actually, we believe the data on the failures is even more important. But because we've got this monthly data from companies, this quarterly valuation to see how the company's succeeding or not, to correlate these different factors, we've got a very rich data model to work with to inspire our investing, as opposed to, at some point we probably will share it, but as Michael said, our focus is on let's just make money with our fund rather than getting that out there. And maybe we talked with something like 5 or 6 different entrepreneurial groups to partner with to actually work with them to roll out this data model. We've never found the right partners, so we'll keep using it, keep making money for our investors anyway.
So in the past 8 years, you invested in more than 400 startups, right? And you're quite deploying every week, right? Kind of, you have certain mechanism that every week you deploy in few companies.
So we do.
Can you elaborate on how you do it at that pace, and how do you manage such a large portfolio?
Yeah. So the first thing I want to get back to is the poker analogy. So when you sit down at a poker table, you never argue the size of the ante or the color of the chips or anything like that. Essentially, we want to minimize the pain to the entrepreneur. So you're doing a safe, we'll do that same safe. You're doing common shares, we'll do that same common shares. Do we ask for any special privileges, anything different than any other investor? No. Again, we want to minimize the pain of that 10K kind of commitment. The real due diligence, as we mentioned, comes afterwards. So from that perspective, we just get started with them right away. I like to say we are price takers, not price makers at that 10K round. So again, I don't know you well enough if I've just onboarded you through our processes to tell you, Yuri, that you're overvalued or undervalued. I'll certainly have an opinion about that when we're looking at the follow-on investments. So the negotiation dance is taken away. The term back and forth piece is taken away. So it really allows us to focus on, let's validate this from a referral perspective, and then let's just go.
Do you require co-investors?
Nope, not at all.
Or you can join as the first check-in.
Nope, yep, absolutely. And that's interesting because some of those discussions are very interesting because I have been that entrepreneur that has priced my early round too high, creating pains for some of the first investors that I brought in because you're doing a down round, which has its own challenges and optics issues. So we'll share all of that, our opinion. We'll give an opinion of what we think that the value should be going in. But again, we don't sweat it. All of the money is made on the follow-on checks. Yeah.
By the way, we have a subset of our entrepreneurs who, and this is an exact quote from them. They've said, Kamal, I would never take any money from a venture capitalist. I don't want any other investors in this company other than myself, but you're not a venture capitalist and you're different. So we'll be just my money and your money, and that's it. And there's been a handful who have said that, but it's shot. But there really is one of the other advantages of sourcing through only the two networks is because the networks talk to each other. So we've got, at this point, we've funded over 200 different INSEAD alumni. When we started, the first 20 deals we did, we only had 2 INSEAD alumni who would take our money. I was begging them on bended knee to sort of, please take money from us. Now, we've got, there's a guy came to us recently. He was running a company in the first online grocer in Singapore, exited that to a big Chinese group, made a bunch of money for himself and his venture capitalist, launched his next business. His name is Roger Egan. And he came to us out of the blue. He said, Kamal, Michael, I don't need your check. I've got tons of money, but I've heard that you've got a good network to support entrepreneurs. I'd like to be part of that network. Are you interested in joining? But that's the sort of, it feeds on itself. We're now in our 8th year of running this fund. And when you've got all these entrepreneurs who we have treated well, then talking to their friends, then we have access to the best deals in our network. And that's one of the problems with taking a deal off the street is, how do I know if it was this good a deal, why is it still available? Why hasn't it been snapped up by other people from their networks already? Whereas because we've got our focused networks, we can feel comfortable that, yeah, we're seeing all deals, including the best ones, we've got a chance to get into rather than only seeing everyone else's rejects.
You built amazing community, right? It's a community-driven play now, right? It's initially you started, it was small, but now that you build, 1,300 advisors network, probably around 800 founders network, some of them become advisors, right? LPs. So what did it take? How did you grow the network and how do you utilize it? You already mentioned a little bit, but maybe you can focus on that.
I don't know that there's a lot of magic except for putting in the right structure and then just grinding.
I would add one thing to that, especially when I look at the initial people. There's a lot of people who say, if you treat people well and do them favors and so on, that's a very naive way to live your life. You should look out for yourself all the time, and who cares about anybody else? And yet, when you spend your life, as both Michael and I have, treating everybody well, trying to circle back and sort of go out of your way to help people, you build up this incredible network around you of people you've done favors for, who, when you then turn around and say, hey, would you like to support me by becoming one of our advisors? They are more predisposed to say yes. It's like, oh yeah, you did this for me, for my business. Sure. So we've built this network of, when you start something like this older in life, when you've got these networks around you, the initial impetus, they always say, when you're launching a business, you don't really count the first couple of hundred customers, because people should have a network of a few hundred people around them. We're just lucky that we had some really, really high quality people in our networks, thanks partly to INSEAD, I would say. We've got some amazing quality people in our network. I mean, both of us were on the the Alumni Association of Canada. I actually ended up being the president of the Alumni Association of Canada. It's a pure volunteer job. You're giving up hours of your week to do things for the community, and you get nothing out of it. But because we both did that volunteering, you build up all the other people in the community know you. And that's so yes, I mean, as Michael said, it was just grinding. It's get a really good offer out there where it's in everybody's interest to join you. It's an offer which is too good to say no to. There is the grinding, but I would also say there is everything you've done in your life up to there to give you that community of people who are predisposed to want to support you.
And then there's a positive flywheel. So look, many of our advisors help out portfolio companies by making introductions to their network. So some of it is very, domain specific. It's knowledge that they're transferring. Other times it's network that they're sharing. So we say, to our advisors, if you are referring them to somebody outside of the loyal network, please do two things. Number one, as a courtesy, remind the entrepreneur that they're not part of the loyal network, because then they won't be under NDA. So be careful with the confidential information that you share. And two, if they're a great advisor, send them to loyal, have them consider joining the network, right? So again, you treat people well with the right incentives, and it's just a positive flywheel. So that's how we've done it.
How do you engage all your advisors, right? Like do you have some matching algorithms, like new portfolio company joins, what happens?
Yeah, the first matching algorithms are the 15 humans that meet with the CEOs on a monthly basis. That's matching algorithm one, is actually ourselves and the venture partners who have heard of some of our advisors, who understand some of these problems. We're trying to build this culture with the entrepreneurs, and our own culture of, look, 1% of the problems you encounter with a portfolio company CEO, you can say, hey, Yuri, listen to me. I've stepped on that landmine. You need to do this. 99% of the time, you should be thinking, who do we have in our network that's forgotten more about that problem than we'll ever learn? So some of these advisors have built up reputations within Loyal, and that they're known to us, the humans. So we say, go talk to Yuri. He's an expert on pricing. Or whatever it might be. Then there's two other ways. Right now, if you go to the Loyal website, you can see the portfolio companies. You can sort by sector, geography, etc. If you're an advisor, you're behind the firewall. You'll also see what the entrepreneur is asking for help in. Mm-hmm. So you can say, oh, I see Yuri is looking for help in go-to-market or fundraising or search engine optimization, whatever. So that's there for the advisors, and then the advisors can reach out. And then conversely, as an advisor, you tag yourself, so your backgrounds, your skills, your attributes, and then the thing that you like to mentor the most on. So then you're available in a searchable Airtable. Now, in all of these instances, and this is very important, especially because we're operating at scale, everything is a double opt-in. And by that, I mean, your time is precious as a CEO startup. Your time is precious as a startup advisor. Both of you have to agree that there's mutual willingness to interact. And I like to say to my portfolio company startup CEOs, be upfront about what you want. So Yuri, if let's say you were a pricing expert, but I also see that you worked at Procter & Gamble, and I don't want to talk to you about pricing. I think my pricing's just fine as a CEO. I actually want to talk to you about who do I sell to at Procter and Gamble. Don't spend 20 minutes on the phone with Yuri getting to know him talking about pricing when you really want to ask him about getting to Procter and Gamble. Be upfront about that. So in the request in the system, again, you can say, no, Yuri, I'm not interested in talking about Procter and Gamble. I'm only interested in talking about pricing. And we're not going to hold that against you. Our whole model is about fractional excellence. So I would rather have you available as an advisor when it's the right match for your skills and your availability, rather than to force you into a process that excludes you. So maybe you're typically Southern European and you take 6 months a year off. Right? That's fine. So you're not available during those months. Again, I would rather have you for those 6 months as a great resource for entrepreneurs when you have. So we've got a variety of mechanisms. They're all managed under this mutual respect of opportunity cost.
And we did have an AI matching algorithm that we were testing out about 8 months ago. Weren't really happy with the quality of it, so we took it offline and we're developing V2. So we'll probably roll that out in the next couple of months also.
Yeah. So again, look, as an entrepreneur, you've got 15 different priorities, and survival really is about ranking those priorities. Many of the systems we've built for Loyal focus around, customer service orientation. But to us, most of the systems were built predominantly and first around the entrepreneurs, second around our investors, and third around the advisors. So now we're coming to build some more systems for the advisors to get more value out of the network. And we thank them and ask them for their forgiveness for being third. It ranked in importance, and I'll openly, happy to put them in that ranking and explain why. But yeah, it is a wonderful human capital asset that we have built, and we want them to get as much out of the network as possible.
What do you do for inter-founder collaboration, right? Because you have different markets, different segments, how they collaborate. Do you host events? What do you do?
Yeah. So look, we started off with all the basic things you would expect, a founder Slack channel, and let them self-organize for some of that stuff. And we often, I think both Kamal and I are built in a more collaborative manner. So we'll encourage portfolio companies to talk to each other if they're in a similar field. They don't have to. We're not going to judge them differently. So obvious, groups, within the Slack channels and environment, we'll try to collide them. We'll say, we'll always send entrepreneurs to entrepreneurs. Go ask another entrepreneur in whatever, consumer goods or in, earned wage access. Who are the best Loyal advisors to talk to? Get the goods from the entrepreneurs, because entrepreneurs will always give you a straight answer for the most part. We've started off. So look, our venture partners, we've got the 12, 13 of those. They all work a day or two a week. Some of them, look, GPs do three things. They manage portfolio companies. They manage operations, and they manage investments in LPs, right? So that's getting new LPs, servicing existing investors. Our venture partners also do an active in all three of those roles, primarily in the helping out portfolio companies. But then we have some that have passion projects and backgrounds. So one of them had was like, okay, well, I really like the YPO and EO model, and I think it's really important that we establish peer support groups for entrepreneurs so they can go and really vent, get some psychological support from somebody who's going through the same thing as them at the same time. So yes, I think Kamal and myself and many of our venture partners get some empathy points from our founders, because we understand what it takes to build a business. But that's a little bit different than going through that, oh my God, am I going to make payroll next month? And other associated existential questions that some of our entrepreneurs are going through. So anyways, long story short, they launched this, they piloted a peer, entrepreneurship peer group facilitated by some of our expert coaches that we have in our advisor bench. It went really well from a feedback perspective. So now we're rolling it out more broadly across the portfolio. So we too are, having these pilot projects and initiatives. We're getting feedback from the entrepreneurs. Does this create value? And, can we continue to support it? And then we roll it out more broadly. So like many of our founders, we've got some skunk works projects. We've got some things that we're testing. And ultimately, let's have our customers vote on what should stick and grow.
By the way, that's an important word that Michael used there, is the word customers. One of our entrepreneurs, there was a quote, and he was just talking, we just pulled it off of our little note taker, and he said, loyal, great, really differentiated firm, all the rest of his. Then he said, you treat your customers exceptionally well. And I think that's a really big difference, is that Michael and I think of the entrepreneurs as the people who are creating the value, and those are our number one customer base. It's just, that's not the experience most VCs, most entrepreneurs have with the VC. They don't feel like they're the customer of the VC. They feel like they're the product of the VC, and we treat them like a customer. And it's shouldn't be strange, but it's what we do, and apparently it's pretty unique.
Cool. So let's step back to the fund, right? So like in order to form the fund, you had to raise money from LPs, right? And in a way, you treat LPs also as a community, right? And also like how do you provide liquidity to the LPs?
Yeah. So we have it. So legally, it's a redemption back to the fund. You buy units from the fund, or you ask the fund to redeem units back again. And it's just like buying a mutual fund. You've got, you bought the units at $1.20 a unit, and now you want to sell them at $1.85. The price is $1.85, and you say, I want to redeem some of my units. We have rules in there to basically try to both protect the fund and provide the liquidity. So it's a quarterly semi-liquid, a quarterly liquidity with gates. The gate is that no more than 50%, 50% of the new money in is reserved for redemptions. So if that isn't sufficient that allows new money to keep coming into the fund. So all the people who are staying in the fund say, you've still got money coming in to grow and to make new investments. That's good. But in terms of the redemptions, if there's too many redemptions, and there's been a few quarters where there have been more redemptions than we had the money set aside for them, it's been a tough 2 years for venture. And in those quarters, we do a partial fill. You want to sell 100,000 units. We say, I'm sorry, Yuri. I think like at the end of last year, we did 69% fill rates. Like, sorry, Yuri, you wanted to sell $100,000 worth of units. You're only getting 69,000. Here's 31,000 left. Do you want to sell it next quarter? Do you want to hang on to it now? You only wanted the money this quarter. So, and then we just sort of go through a prioritization like that.
And in the quarters where there hasn't been redemption requests, the money is not held in a liquidity pool because it would drag down returns. It's immediately deployed. So with Loyal, there's no capital calls, 100% deployment of capital every quarter. In fact, at our LPAC, where we get them to validate the pricing that we're going out with, we also set the maximum amount we're willing to raise. So if you and I and Kamal were starting a new VC fund, and we said, okay, guys, let's go out there and raise $75 million for our fund. We're going to deploy 50 million of it and follow up with another 25. And we encountered an LP during fundraising. And that LP said to us, hey, guys, I love what you're doing, but I can't cut a check that's less than 100 million. 99% of folks raising money would say, no problem. We're unicorn hunters. We'll figure out a great way to deploy that 100 million. Don't you worry about it. With Loyal, we will not violate our discipline. It's a slippery slope. We know exactly how much we can deploy based on the maturity of the model. So right now, we have a fantastic deal warehouse. We can deploy about 8 million per quarter. As we start writing the next size checks, as the essentially warehouse matures, as you will, that'll go up to 16 million per quarter. That's the size of the fund on a steady state basis. We're deploying $16 million per quarter.
Or annually, $30 to $65 million a year. Yeah.
You also mentioned the LP kind of co-investments, right? Like how LPs can co-invest, right? Like typically I invest in a fund, and then they forced me to invest through an SPV, and they cut more carry, right? It's kind of through that side vehicles. What is your model of doing these deals?
So I want to go back to when we were in fund formation, getting feedback. Look, we got a lot of feedback, and they said, guys, we love your geographic distribution, we love the diversification, we love your use of advisors, we love the staged capital allocation. That makes tons of sense. But actually, maybe your capital allocation is a little bit broken from the classic sense. So let's say that you guys are
too disciplined.
Yes. Let's say that you guys are at that $1 million stage or the $3 million stage. You have what you think is the next Uber. You have a unicorn by the horn. You've probably led their last couple of rounds. You have this fantastic relationship with the entrepreneur. You've got money in the bank. Why would you limit yourself to only $1 million or $3 million or whatever your stage is at? And our answer has been, we've promised our LPs discipline. So what that does, though, is look, business 101. If somebody lets you into a deal, you have to ask yourself, what's so special about me? Why am I being led into this deal? If you're one of my LPs and I say, Yuri, if I could have invested more than $1 million into this company, if I didn't tie my own hands, that's where my money would have gone. That is a super strong buying signal. So what we haven't mentioned is our North Star metric of the fund is that 98% of our portfolio companies have accepted our follow-on offers when we've made them. Put differently, folks want our money in. We're considered smart money or good money. There's a bunch of different names for it. But fundamentally, this is a relationship business. So if Kamal's my entrepreneur and you're my LP, and we've just put in $1 million into Kamal, and what I can do is I can call Kamal up and I can say, look, I've one of my LPs, Yuri, he's a great guy. He'd like to make a direct investment in you. Will you take the call? Kamal will take that call. And right now, from a customer service perspective, again, because LPs are second after entrepreneurs, we don't have it yet so that you can press a button and divert more of your money into a specific investment, but we will make that intro. So you'll talk to Kamal, you'll show up separately on this cap table, you'll sign a separate set of subscription docs. So again, that we've turned around that perceived weakness into a strength for our LPs. And I know that if you look at the venture landscape, family offices and investors haven't been investing as much into funds, but are certainly always wanting to get into these very hard to get deals. And Loyal is about building that reciprocity with the entrepreneurs. I like to say, if you put Kamal and myself, our 13 venture partners, our 1,300 advisors, you put them all on a cruise ship and you sink that cruise ship, our LPs will still have good results of good decisions previously made. So the reason we put in all of this energy is to be in that place, that desired place years from now. When you're an entrepreneur, you're starting off, nobody wants to give you money. When you're success, there's a lineup of investors at the door. We as Loyal want to already be in the room. We want to be obvious to the entrepreneur, like we want to take their money, and we want to be able to invite other people into the room, and we've been able to do this. So that's the very long answer for your what about co-investment question, Yuri.
Quick question about what is your end game, right? Because
yes.
like in VC funds, you have you exit the whole portfolio and you get rewarded with your carry. What is the end game for the team when you get rewarded, and what should happen?
The nice thing about being a quarterly semi-liquid fund is we take our carry when our investors make money. We've already had investors who doubled their money in our fund. They put money in, they took some out later, they doubled the money they put in, and we got our carry on that. So here we are. We got our first carry, I think, in year 4 of the fund. We're getting carry. So we're getting the compensation we want. Look, both Michael and I.
So you get carry when someone exits.
No, but only if they've made money, Yuri.
Yeah. Okay. So if you put in $100,000 and you cashed out the 69,000 I was talking about before, we don't get any carry. You haven't made money. But if you put in 100,000 and then you cashed out 200, you cash out another 200,000 after your initial 69,000, then hey, Yuri's made 169,000. We'll take our 20%. Thank you very much.
In terms of when exit happens in one of the portfolio companies, how does the money flow between all the participants?
It's forced distribution. So when you're buying units of the partnership, in Canadian LP GP structure. So it's a full flow through. Your tax issues are between you and the country you invest from. You have a percentage effectively of the fund. The fund gets in a check. It divides up that check from the proceeds by all the
across all the LPs pro rata.
Yep, that's right.
A distribution. I mean, think of it conceptually like a dividend, only it's not a dividend. It's often a return of capital, which is untaxed.
So the beautiful thing about this from a structure perspective is the goal for Loyal is to deliver second quartile, so above average venture returns with less risk due to diversification. We're succeeding in doing it forever. Now, the interesting thing is that the distributions will approach the IRR of the fund, or put differently, this will start to look like a venture annuity. And in that annuity, as it goes along, when any of our investors get to the point at which they've had more money come out than they've put into the fund, that's when carry happens. So put differently, it would also be an annuity for us as the managers of the fund.
But our long-term goal, look, Michael and I both love what we're doing. We love talking to entrepreneurs. We're being paid for our dream job. And we have venture partners who are working a day or two a week. It's really easy for me to see myself in my 80s in the same business, talking to entrepreneurs a day or two a week, where everybody else, I mean, we've found new GPs. We've got all these amazing venture partners who are busy screening. They're the best advisors, become venture partners. Those venture partners work with us as we add GPs. We've got a great pool to do it from. But we've got something where we've designed a fund to live for the next 30, 40 years, something which we hope will, outlive us, with a process we think is a sustainable long-term process. And I can't think of a better job I'd want to do 30 years from now. So why not just keep doing what I'm doing?
Would it make sense to go public with this structure at some point?
We were having a chat just this morning with a regulator about this, because I mean, that's the one problem with the structure we have right now, is it's limited to accredited investors only. We have built a diversified quarterly semi-liquid venture fund, which is amazing if you don't have a venture portfolio. If you can't afford to invest in 30 venture funds the way a pension plan does, but you want the diversification to get preservation of capital, we are an amazing first check to write. Now, you could write a fund of funds. That's another way to do it. You will pay fees on fees with a fund of funds. With us, you just have the one level of fees. But that's what we're designed for. Is we're actually designed. It's a great product for the public. So we're talking with regulators about this being available to the public. But right now, it's available to accredited investors. And we have lots of people whose income is a couple of $100,000. They've got a couple of $1 million of assets. They're thinking about their retirement, and they want to have a portion of higher returning assets in their portfolio to be able to fund a better retirement. That's what we do.
And by high returning assets, he means historically as an asset class.
Last question. So you guys play in the seed game, and sounds like AI is changing the rules of the game, that seed is dead. So how are you guys going to be kind of investing in companies that don't need the seed anymore?
Well, so it's the beautiful thing about our model is we're typically first venture money in anyways because of where we are in the chain. So the rise of seed strapping, maybe the 10K, I know that's very extreme, is the only check we ever get in, but it's more likely the 200K. So the idea of one person unicorns driven by a purely agentic model, we're going to be much better positioned to get into those opportunities than any other fund out there. And again, yes, maybe only in the 2 or 3 networks we operate in, but that's enough. Even though steady state, we're a $500 million fund, that's a drop in the bucket in the venture ocean in terms of investing in. So we're happy to do what we do and how we do it within our world. It's I think everyone should be doing it. We're open and transparent. We are happy to have people look at what we do and how we do it. We'll share how we do it. Look, venture is like entrepreneurship. It's about the execution, not about the idea. So we're executing.
That's great. Yeah, thanks for sharing your journey. Very cool model. And again, I would love to see you at our Global Investor Summit. We are repeating it on November 11. You as the club members, you're also welcome to join us for a retreat this time.
I do plan to do that. I'm looking forward to it. And thanks for having us on, Yuri, and all the support that you and VNTR has given us.
Amazing. Thank you.